Welcome to Trendlines Over Headlines, the show where we break down this week's price action with some of the best traders and analysts in the world. We've got a great show planned for you today. Howard Lindzon is stopping by the studio to talk tech stocks, sentiment, private markets, and so much more. Howard is really a man of all markets. He's a trend follower, entrepreneur, venture capitalist, known for his early stage investments in companies like Robinhood, eToro, Koyfin, YCharts, Rally Road, and so many more. He's also the founder of StockTwits, a social media platform for traders and investors where I first got my start nearly a decade ago. Howard is constantly talking to company founders, CEOs, analysts, and traders, so he's got a really unique vantage point on both the public and private markets. But before we talk to Howard, it's Friday, the markets are closed, so let's take a quick look at how the markets fared this week. All right, so all four major indices closed lower this week. The S&P 500 lost about 1%. It closed nicely off its lows, which was encouraging, but we're still in a downtrend, and we closed below last week's high, so it's tough to get too excited here. Looking at a more broader measure of the market, the Russell 2000, it's continuing to hold those 2018-2020 highs, which is constructive as long as we're above there, but we still have yet to see a decisive rebound off that key level. So that's definitely one to watch in the near term. So moving on to the sector performance, consumer staples was the only sector to close higher this week. And again, it's not the kind of sector that you want to see leading. It's more of a defensive, kind of safe haven sector. So really nothing bullish in terms of sector performance this week. As far as the laggards go, energy continued to correct. So that was the laggard there. But let's move on to our conversation with Howard Lindzon. Howard, thank you for coming by the studio today.
Beautiful place.
I know. I can't believe we got you off Coronado Island.
I do leave Coronado's phenomenal, because San Diego's so close. And some people don't like driving over the bridge. I just find driving over the bridge is like driving over this piece of art every day, and the city's really wide open.
Oh, it's a beautiful bridge too.
And San Diego's 5 minutes away. I love it.
So I want to talk stocks, and then we'll get into private markets at the end. But this is a technical analysis show, right? So let's kick it off talking technicals. When you Google your name, Wikipedia actually has you as a technical analyst. They have you listed as a technical analyst. And I don't know if that's how you necessarily introduce yourself as a technical analyst, but you are a trend follower in both the public and private markets. You ran a hedge fund for about 8 years, and I know you read the chart report regularly. So what kind of drew you to technicals in the first place? Was it the trend following aspect of it, or?
I don't know if I've ever been. I just feel like the markets are this like this art, right? And so it's a combination of buyers and sellers and volume, and so charts always were this like beautiful moment in time picture. And like flash forward today with NFTs, we'll get to that, but like stocks were always this like perfect encapsulation of how people feel at that moment, plus how they felt all through up until that moment. That's, depending how far back you want to look at a chart. So charts were always interesting to me because you could learn really, picture tells 1,000 words. And so I don't love the word technical, but I've been I call chart art. I've been fascinated with just like what I call chart art forever, because you get caught up really fast. Like you can go read 1,000 years of history about Nike and all the stories, then you look at the chart and go, oh yeah, there was a recession there, and no matter how good and this is when they signed Jordan, and this is when they launched, Air One.
It's kind of like pictures worth 1,000 words.
Yeah, I mean, it tells, like if I was going to do a show, I used to talk to Danny about this all the time, and even JC, if, music, we're already off topic, but like if you go, like they have all these music shows, like, because you can see when they wrote the song, what they were thinking, what the genre was, and charts can give you a history of what the economy was like, who was president, what was going on in, foreign, and what products were being launched, because the chart tells you all that. And so you go look at the 30 best charts of all time, and they're all going to kind of look the same. Yeah. The stories will be different, but all great companies have kind of the same pattern. Right, they launch great products, something the market wasn't expecting, and they don't have a lot of competition, and the margins are very high. And so you go just teach people how to invest by telling the story of 10 great companies, because you learn from spotting these patterns. So for me, technical is more about pattern recognition.
Spotting trends.
Yeah,
right?
But spotting trends or spotting ending of trends or spotting all kinds of different things by looking at hundreds of patterns over and over. You just get better at doing it. I mean, why are some people into art and are good collectors? Because they've studied it and stared at enough art their whole lives through books or on the wall or whatever, and they become connoisseurs.
Yeah.
And like JC, or for me, YCharts, JC and I, when Josh Brown referred me to him and we brought him on to StockTwits, I mean, he just understood best how to, even though he's a technical analyst, he understood the art of it more, and he was a young millennial or Gen Z. I don't know what JC is now because he has kids, so he's nothing. He's just tired all the time. But
He's got twins on the way.
I know. So he understood how they just tell stories, and it's pattern recognition. Like people that get caught up in the technical side of it, and that's why I hate the term.
Yeah.
I think it's more about, hey man, this is a beautiful representation of how people are thinking and are feeling. And if you can start understanding how that all works, you'll be a better investor.
Yeah, the godfather of technical analysis, Ralph Acampora, he's got a great quote. He says, I don't call it technical analysis anymore, I call it data visualization.
Yeah,
and
I just call it chart art.
I think it's really interesting, though, because we've only had the ability to really rip through charts like this in the last 2 decades, right? I mean,
yeah, I used to have to wait for the books from Value Line or whatever, these great IBD books or whatever. They would come once a week, like printed.
Yeah.
And you had to like flip through them, and there was no way to like...
You actually got them?
Yeah, I loved it because as a young investor, I didn't
and
want to learn.
What was this
It
like?
just took you all weekend to go through these chart books because there was no internet. But there was no way to search and archive and compare. And now, like with Elasticsearch and with just every site has great
with
search.
Koyfin and things like that,
I mean, kids today. But the reason investing is so popular is still because it's an art form and it's a language and it's something that people get into, whether it's Chinese or French art or investing, people get fascinated with this language. Some people are just able to learn the language of this.
Yeah. So I want to get your thoughts on today's markets. Here we are just past the halfway mark of the year. It's been one of the worst starts to a year in history. Yeah. There's no sugarcoating it. And tech stocks have been especially hit hard, and I know that's kind of your area of expertise. So, if you had to guess, and obviously there's no right answers here, or no wrong answers, whatever, what do you kind of think the second half of the year looks like for the market?
Well, for me,
for the NASDAQ.
Yeah, for me, it's brutal. And so the only savior that I've had is that I'm chicken, and that because everything that I like is down 70%. So the only reason I'm not down 70% is like I tapped out down 30%. The only difference between me and Kathy Woods, I joke, is that she's she doesn't care. Yeah. Meaning you can't let everything go down 70%. Like we're all wrong all the time, but we are at a serious change. Started in 2020 with COVID, and then 2021, euphoria. And even though a lot of these great tech companies have great sales and they have business models, they've been growing with capital that didn't demand profitability. And all of a sudden, people care. I can't explain why, but it's inevitable that happens in markets, that valuations matter. And so it's not just like a 6-month thing. So I think we're at like a serious change in how people are thinking about the markets. Valuation does matter. We can't, I had a great guest, Lewis Johnson, on my podcast, and it's like, we don't have commodity, like we don't have enough stuff in the ground. You can't raise interest rates and produce more natural gas. We actually need lower interest rates so people will speculate on drilling holes in the ground. So it's unfortunate we had to raise rates to kill the speculation in one area, but that doesn't help the fact that we need commodities. Right. And China's shut, and Russia's shut, and we don't want to take their stuff. So we're fucked, and that's not pleasant. But people not understanding that basic supply-demand issue, the market wants commodities because people are employed and they want to buy stuff, and you can't get parts. So imagine just a wheelchair, for example, and you got 99% of it built, but you need a screw for the last 1%. The 99% is worthless because you've been relying on a globalized economy to get you that screw just in time.
Yeah.
So now you got like the whole chair waiting for one part. And that's kind of what's happened to this economy in a globalized world. So we got to undo all that, theoretically, because of recency bias. Say that part starts getting delivered. You're still not going to trust your next order that it's going to get delivered. So and this is how markets work. So there'll be recency bias. Even if rates start dropping tomorrow, you have to count the fact that people are going to think differently because they just experienced a horrific internet crash, horrific tech crash. So it's not like they're going to load back up on tech the next day. So short term, I have no idea. Honestly, the next 6 months could see a 50% rally in tech, but will that change what I think? No, I'm pretty concerned about investor behavior, and they're still gambling on GME. They're still speculating on stocks that make no sense to me in an era where they're not willing to buy Netflix down 70% or Facebook down 70%.
And it is down like 75%
so I'm saying,
right now.
The investors, I'm not saying they're cheap, I'm just saying investors are willing to still speculate on weekly options and are still willing to speculate on AMC and GME and crypto, and Netflix is down 70%.
Right.
So I don't feel that's healthy.
It's still that kind of get rich quick kind of mentality out
so
there.
I think we're still going to have a tough time climbing.
Well, so that kind of brings me to my next question, because as the founder of StockTwits, I think you have a pretty good read on sentiment, and the sentiment surveys have been bearish all year, and it hasn't mattered, right? Yeah. And we know those are pretty flawed, and sometimes the best approach to sentiment is, I think, anecdotal, right? Yeah. And I know you talk to a lot of company founders, and so based on the conversations you're having and the things you're seeing, what's kind of your read on sentiment right now? Are we at that point of max pessimism yet, or you're kind of saying?
It's the hardest time I've ever seen to read sentiment, because it took so long for us to flush out it on the positive side. It took COVID, in thinking a lot of this through, in 2019 WeWork imploded.
Right.
If people don't remember,
that was 2019. So I guess that was before the pandemic, wasn't it?
And SoftBank imploded, kinda, and there was like a mockery, right? And WeWork wasn't like a bad idea, but it was abused, and it wasn't really.
Do you think in hindsight that was kind of the early?
That was the top. And what happened was that everybody. Luckily, it never it went public. It just got outed just before.
Right?
No. It went eventually, but I'm saying just before it went public, the whole thing imploded. If that had gone public and imploded, that would have been the end. Okay. Yeah. But it didn't, and so it didn't affect retail. And then, if you had told me that, and SoftBank was kind of ridiculed, and this whole idea of raising so much money was stupid, and they weren't doing due diligence on the founders, and it all made sense. So if you had told me 3 years later that there would be 10 SoftBanks, Tiger, D1, Co2, everybody became SoftBank. So that was not a bet that you could have foreseen when WeWork imploded. In a normal cycle, that would have been the top. But for whatever reason, the party kept going, part of it COVID, which should have also, you could see the market tipping over in December, January. COVID really tipped it. And what happened was print. Unlike if that pandemic had happened in 98 before Web 2, there would have been chaos, right? There would have been, trying to get a message across to have people work from home. There was no Zoom, there was no Slack. So what happened was, COVID happened. We all realized, wait, we can still work. So the party raged on, and it sucked in all the last cynics into the internet, which is good and bad, meaning now everybody's online, everybody knows they can buy shit online, but everybody also believed they could get rich online. And I think that, in hindsight, it's easy. The speculators just were like, okay, I missed it, I'm in, right? And then crypto and no regulation and blah, 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 and SPACs, and there wasn't enough supply. And really what finally killed it was just so much supply.
This is like the hangover effect kind of thing.
Well, there's just so much supply, and none of it is good. So you had so much money, and then you had so much paper, and that's not good. And then you also had China's real estate market implode in 2020, which is what, $60 trillion, which is bigger than the whole US stock market. So I mean, there were a lot of warnings that US investors just were ignoring, including everybody, myself. And there's nowhere to hide when markets crash, right? Like people were hiding out in crypto. That's not a place to hide out.
Well, so that kind of brings me to my next one. So Apple, one big head scratcher from this week was the fact that Apple's actually holding up relatively well in this market, and that's the largest stock out there. I think it represents 7% of the S&P, and it actually broke out to an all-time high on a relative basis yesterday. So you're seeing kind of a rotation into Apple, which on one hand, like it's a tech stock, right? Is that risk on, or is it kind of acting as a utility or a staple? What's kind of your read on that?
Well, it's Warren Buffett's biggest position, and he has the most cash.
So maybe he's putting some to work?
Well, I would think any dip, that's his index. So he's got money to put to work, so he's definitely buying dips, I imagine. So I shouldn't say definitely, but I imagine he's buying dips. It's not interesting to me, even though it's one of my bigger positions. It's not interesting to me to add because, like, what's the law of large numbers, and the fact that it's so reliant on the iPhone is still dangerous.
Yeah.
Right. So there's a world where you could wake up and they announce that the iPhone sales are slow because of, eventually people are going to start getting laid off, and they're starting to in tech. But I don't see the risk upside versus downside anymore in Apple. So yeah, it's a place if you're Warren Buffett to hide out, and anybody who wants to now invest in a 20% discount in the indexes. If you buy QQQ or SPY, you're buying a lot of Apple, right? Because market cap weighted, it's the largest one. So I just think it's the last place where people are hiding. So the question is, if Apple drops 20% on news, what will happen to Zoom and Salesforce and Cloudflare and all the tech stocks that are down 80%? Will they drop another 20%? Probably not. Right. So I think, if you must be in the market, people are buying Apple. I would say, this is a really dangerous market, because if that's the relative leader at 3 trillion or whatever, I mean, what alpha are you getting? At that size? The upside versus downside doesn't seem high. So it feels more like it's a hiding out spot than the market's about to turn to the upside. But I hope I'm wrong. By the way, anytime I'm negative, I just hope I'm wrong.
Yeah, no, I mean, to me, it just begs the question.
I'm rarely negative. I've been negative for a year. So about the markets, but I don't feel, just based on behavior that I see in Robinhood and StockTwits and crypto and private investing, people are not paying attention to what they own and what the value is of what they own. And I think the market's been telling people, from China's implosion of real estate to rising interest rates to the fact that Europe doesn't have doesn't have gas, winters, summers end. People aren't listening to the problems. So as much as people are bearish, and they should be, are they bearish enough?
Right.
And everybody seems to be looking to put money to work. That's what Apple's showing. And I don't know if that seems wrong. Even though the sentiment is properly negative, I don't know if it's enough to make me bullish.
Yeah, I see what you mean. I mean, and negative sentiment, hasn't paid to be a contrarian.
You can't just make money as a sentiment person.
Well, right. Yeah.
Yeah, it can be a great part of your thinking.
Right.
But right now, technically, I hate saying that, but technically the market is so weak. And
you're not wrong.
If Apple was breaking out to all-time highs and there was some other strength in tech, I'd be more interested. But Apple relatively breaking out to all-time highs is actually scaring me, because it's just people saying, oh, I need to be in the market still because of inflation. And I'm like, no, the dollar's been cash has been good, dollars at 20-year highs. I'm not saying that's good for the markets. I'm just saying, what's wrong with, people say, oh, you're losing 8% a year in cash. I'm like, no, cash is meant to not lose money.
Right.
Yeah, you're losing in purchasing power, but cash gives you confidence. Cash gives you the ability to do things.
It allows you time to think.
And I'm telling you, man, this is a good time to be thinking. This is a great time to be living in the future, because prices are coming down. So you want to be speculating with your time and playing with things, because people are stressed out. But this is a great time, if you have free time and some cash, to be going, okay, this is a great time when everybody's worried and switching jobs, to think about what really is the future going to look like. And if it's just Apple, we got problems.
Yeah.
Okay, but at the same time, I love Apple, but I don't think it's enough for me to like have an edge in the market.
Yeah, I mean, to me, it just begs the question, like, if Apple wasn't doing what it's doing and holding up relatively well, where would the indices be?
Well, I think we're better off if Apple breaks.
Yeah.
So we know how people really think, right? Like, get it over with so I know what the world looks like with a broken Apple. The last time Apple broke was awful. It was like 2018 and the China stuff with Trump, or 2006. I forget what year when Trump was like, China this and China that, and he was storming around, or he was going to close the government. And so at the end of 2018, and Apple was just acting like death. And that was a better time. I prefer when the best companies are acting like death, but right now you have Netflix, Facebook, Google, Amazon acting like death. And how is Apple that much different than them? So I'm more worried about, like, let's see what happens when Apple doesn't do well to these other stocks so I can have a better feel for what the bottom looks like. But if I'm wrong and Apple leads everybody higher, great, I'll buy the market higher. Yeah.
So let's move on to Bitcoin. Bitcoin and Ethereum, really, they're both continuing to just hang in there at that key level, those 2017 highs. For Bitcoin, it's around 20,000. And obviously, it's been a terrible year for Bitcoin too. And it's kind of the same question as the NASDAQ, right? Because they've been trading almost in lockstep this whole year. So I wanted to see if you had any opinions on crypto, both in the short term and long term. And there's this great quote that I love from Seth Klarman, and it's, "Every bubble starts with a good idea carried to excess." And do you think that's kind of what's going on in crypto right now?
Well, my only expertise in crypto is that I've invested in some funds that have done well.
I've heard you've done pretty well.
But I've also now down in those funds a lot. So the lesson is you sell some on the way up, but you never get the top. So I'm definitely having a tough year, or the funds that I'm in are having a tough year. There's no hiding. So the way I look at crypto is it's an asset class, much like commodities, so it's part of a tech portfolio. It's more venture, so it's more like private tech. It's public-private, meaning like you can trade it, but really what is it? It's venture capital. There's no cash flow yet, or maybe ever. So it's a weird asset class.
Would you look at it as like a liquidity-driven asset,
I think so. I mean, so far it's acting, people say inflation, people say gold. I think Bitcoin and gold make sense to me, and I don't want to own Bitcoin because it's gold. To me, Bitcoin is Ukraine. Right? If you lived in Ukraine and all your money was in gold and you had to leave in the middle of the night, shame on you. Bitcoin existed. Okay, and you have your money in the cloud and you leave. Americans can't think like that. We can't imagine waking up that we have an enemy that would drive us from our home. We couldn't collect our safety deposit box or dig under our house, where we were going to stick gold or our watches or whatever we think is something that we need to move. Bitcoin totally makes sense. As someone who's watched Holocaust videos or seeing what's happened in Ukraine, like the cloud, if you're going to have to pick up your life and move, Bitcoin makes sense. Volatility aside, at least you have something that you can plug in, you have your password, you can live, whether it's 10 grand or 100 grand, right? And your house. So that always made sense to me. That's insurance. So what percentage should be in insurance? If you believe that in the supply constraints of Bitcoin, 1%, 3%, 10%, I don't know, depending on what you think your risk of flight is. Everything else is just venture capital. And so to me, the reason I don't speculate in it other than through some funds is I just can't figure, it doesn't, I grew up on stocks and cash flow and valuations, and none of this has been written yet. Everybody's making up the rules as we go along. So there's no standard kind of ways to value these things. Right. So who am I to value these things? So right now everybody's valuing it based on technicals. That's not a way I want to bet my money. I'd prefer to take my risk capital right now in a tough market and speculate on things that I really believe in and I'm using every day. I think where we are with crypto, and this is like Warren Buffett is right at some level, is he made his bet on crypto through Apple. He's not going to talk about Bitcoin, but Apple's going to solve.
What does Apple have to do with Bitcoin?
Because they have a wallet, okay? Because you do everything through your phone, right? But since it's not regulated, what the hell does it? And since there's not tens of millions of users every day spending, why does Apple even want to dabble in this? They can wait, much like Google waited with Google Chrome until the browser becomes a thing and then launch their product.
I see.
So Apple has all the users, and what crypto needs is a way to get enough people interested so that Apple and Google get in the space. So it's kind of a catch-22 moment for crypto.
Yeah, it's almost like
they don't want Apple and Google to be in the business,
right.
But Apple and Google, it's not real until Apple and Google are in the business.
They need them, is what you're saying, right?
I need them. Like if I'm going to speculate, I want my stuff to be in my Apple wallet for some reason.
And I think that's one of the biggest problems in crypto adoption right now. And
well, the geeks are in charge, and the geeks don't know how to market. The geeks have been coding their way out of problems. Okay, like we make fun of Madison Avenue and Hollywood and all these places. They know how to tell stories. And Bitcoin was a hell of a story, but it took a long time to tell the story, not in terms of like religion and in terms of gold, but look how long it's taken to get the Bitcoin story out there. Okay, now you're talking about, so Bitcoin's some form of religion. Now you're talking about thousands of religions that have been around for a week. Yeah. And no one's good at telling stories. And you can't even how do you access this religion? And the stories are changing every day. Bitcoin's an inflation hedge, then it's a thing, and then it's a this. I'm like, get your story straight, Jesus. So crypto is kind of like religion, but digital. And the stories aren't straight, and we don't know who Jesus is. And one has like an inanimate God, one has Vitalik, one, Solana has Antonelli. I mean, you know what I mean? It's like an opera at this point.
You made this point a couple years ago. I can't remember when or where, but it was one of the best arguments I've heard for crypto is every time you see these boom and bust cycles in crypto, it attracts the public in, they get a wallet for the first time, they get killed, they get the 60-70% drawdown, but that money never leaves. It just stays in that crypto wallet. I mean, maybe some people take it out for whatever, but that money tends to just stay there until the next cycle. Yeah. And then they're rich again once it, assuming that the cycle continues. But
I called it the flippening. Someone else's name. Flippening was used like when Ethereum crosses the market cap of Bitcoin.
Yeah, which has yet to happen.
But I had a flippening at some point last year because I owned a bunch of Solana, luckily, and Solana was worth so much that I had more money in crypto, cash, than I had in regular cash.
Get out of here.
Yeah, and I wrote about it, and I was like, this can't be good. And I didn't even know how to deal with it.
That must be a lot of money too.
No, I mean cash I don't have, because I invest a lot.
Oh, more than cash. Okay.
Yeah, more than my equities and cash. And I was freaked out because I called it a flippening. I'm like, okay, if this happens long enough.
And you were still sleeping?
No, I don't sleep. But the flippening happened to me. I started out with a tiny percentage of my money in crypto, and through the magic of mirror or whatever, of speculation and a bull market and a bubble, I now had a problem. And this happened earlier for some VCs like Mark Andreessen and Fred Wilson and maybe even Chamath. They were in so early that it became such a part of it, they didn't even need to bring it back because they didn't know even how to deal with the taxes. So they left it over in the digital world. And I think this cycle didn't happen, right? We've had the crash before. If there's another crypto cycle, and I think there will be because it makes sense, US isn't the world, and people around the world have currency problems and storage problems. So I think we haven't seen the last of crypto, but I think it'll be the next cycle before we have the real problem where enough people have enough money in the digital world, they leave it over there to spend on things and games and YouTube and content and subscriptions, and it becomes their internet money. Because if you're a 5-year-old kid, and your parent hands you an iPad, and they turn away. This kid is on YouTube, and they've got the world's serving them up stuff. Yeah. Okay, if they were and if they had their own digital wallet, which they don't even know what a wallet is, but them asking their parents for money is not something they like to do, right? So the crossover thing was Venmo. In the next cycle, these 5 and 6-year-olds will have some digital wallet that their parent sets up with $3, and they'll be trading with their friends,
playing Roblox.
Figuring out how to accumulate this internet money on their own. Some will be the next Warren Buffetts, and then they'll be 8 years old using their money on the internet to get weird content or whatever the stuff they want to do. So I think this bubble ended before that happened. So I think once compute and once Apple and Google and once regulations come in, I think the next cycle will be the one. But you still need a killer app, which is probably the wallet.
Yeah, that's interesting though that you think
I wish.
that
I'm
it's probably gonna
56, so I'll be too old to care, and I'll be in T-bills.
But it's interesting that you think kind of the winners of the DeFi space will be the established tech companies, that Apples and the Googles of the world.
We look at banking, like Wells Fargo. 50% of Wells Fargo's customers still want their statement by mail. So in a world where, well, I'm just saying, so in a world where that exists, if you could go have a helium phone, no one knows what helium, but if you could go have, there's 280. Solange has a phone, but you could have it powered by helium network, right? How many people will still do that? They'll still fucking pay Verizon. Even though they hate Verizon and AT&T, they'll still pay. So what I'm saying is, no matter how far the tech gets, there's enough of the population that's lagging behind. They're still going to want the old way. So when it becomes big enough, Apple and Google will get into the space, but the space will be big enough that a lot of people can make money.
I see. So I want to talk about private markets real quick. From the VCs I follow on Twitter, you'd think it was like the venture markets are just done forever. You'd think they were frozen. And I wonder how much of that's true, between rising rates, inflation, now you got recession talk. What, in your opinion, are some of the biggest challenges facing venture capital right now? And how are you and your partners at Social Leverage maybe making changes to your investment process, or have you pared back on writing checks or what?
Yeah, there's no challenges today. The challenges were for us 2 years ago when prices seemed crazy. Like I'm the old man yelling at my screen going, 20 million for this? Like, so we were, 2 years was my headache.
And
because
was part of that,
we couldn't sell the things that we wanted to sell because they weren't public yet. And we couldn't invest in new things because they were too expensive based on the things that weren't public yet.
Now, was part of that
so it was a catch-22.
That all the money coming in from the SoftBanks of the world that you were talking about earlier?
Well,
was that
came in from the Fed. It was created it was printed.
Right.
SoftBank, people can only copy SoftBank if they have the capital to copy SoftBank, and that was created by fear and greed and money printing and the economy, and everybody needs to be rich. So it wasn't any one thing. I guess you could blame it on political Fed policy, and the Fed's become politicized, so they don't want the market to go down. So you had all that happening, and so for people like me, who have been doing venture for at least 15 years, it became tough because it brought in all these new people. That's what happens in a bull market. So I'm competing against all these new people, but there's still all these great brands that were there before me that don't have the same problems as me. They can raise money. I can't afford to lose money for my LPs.
And you're specifically,
because I got to keep going to raise money.
You're specifically more early stage, right?
Yeah, but let's just call it all a venture. What happened is too much money in the system. The old brands that have these relationships with institutions, they can make mistakes because they have the relationship with the institution. They can go back, oh, sorry, we lost 300 million, but you got to be in our next fund, because if you don't come in our next fund, you're never going to get back in.
Is that permanent capital?
Okay. Pretty close to permanent capital. Then there's the new guys coming in saying, this is a bull market. I got to put my money to work so quickly because I can raise my next fund. Okay. And then there's us in the middle, which is like, holy fuck, it was so hard for us to raise money. We can't afford to lose money. And this market makes no sense to us. It's like the bears, too hot, too loose, too tight, too cold. You know what I mean? The three bears. So we were stuck, like, what do we do? Do we write checks that don't make sense to us so we can raise more money but potentially lose a lot of money? Or do we do our job, not write checks? People think we're not working hard, and we didn't write checks because it's like, how do you at least in the public markets, if you overpay for something, you can change your mind the next day. So my big problem was these people are writing checks and your money's tied up for 10 years. Yeah. So like, that's not the same as like overpaying for Zoom. You buy Zoom at 400 and it goes to 300, you can sell.
Yeah.
You buy an overpriced startup at 100 and it drops to 50, you can't sell.
Yeah.
So like, you have to think mentally. People weren't thinking through IRR and DPI, which are like measures that matter. Like the DPI, what you return in cash to your partner matters.
Well, it was like
IRR
momentum.
means nothing.
It was almost like momentum
without
within
liquidity.
Private markets.
Momentum without liquidity is just
yeah.
stupid.
But you know what I'm saying? Where it was almost.
I know
like
what you're saying. I was living it, so it was very frustrating. So no, I mean, this is the best. These are the times that I love. Because what happens is, let's just give you a simple example. Twitter, all the social companies. So they're all down 70%, Pinterest, Snap, Twitter.
At least.
Okay, so if you came to Pinterest, Snap, Twitter in the last 2 years, your stock options are worth zero. So they could pay you 300 grand a year, but the 300 grand a year you're gonna get in options, you're never gonna see.
Yeah.
So the only way to do that is to switch from Twitter to Pinterest. So the recruiters are saying, hey, if you're a product guy at Twitter, they recruit you to Pinterest because at least you can reprice your options.
I see what you're saying.
Okay,
Yeah.
so that's going to be going on. Unproductive, employees moving around in this vicious circle around enterprise. So, right, you got to reprice your options. The company can't reprice it because that's dilutive.
Yeah.
So now they have the unproductive thing of the guy they trained for 3 years is now going to take that knowledge and move to Pinterest, and the Pinterest guy is going to move to Twitter. Okay.
But what if they all suck?
Of course. So, but we don't know who the next Yahoo is, so they could all be going to the next Yahoo. But the ones with the big ideas who are unhappy about how things and have better ideas will leave and start new companies. Okay? So this is a great time when people will say, fuck it, I'm not switching from Snap to Pinterest or Snap to Facebook because, at 300, I have a better idea. I'm just going to go start my own business. So there's a lot of talented people that are going to. The problem that we have right now is twofold. A lot of talented people will leave. That's a plus. Valuations are down. That's great. So you're going to have a lot of great, smart new founders who want to build businesses, and they're going to have more realistic expectations. That's beautiful. The only problem that I see, well, it's a big problem, is the macro, right? So if you're going to start a startup today, it's not like, hey, we're going to go into China, we're going to go into Russia, we're going to have Latin America in the first year. We know that's a lie. Okay, so valuation compression. So the whole market shrinking because we're having deglobalization. And then the second problem is there's no way to get users because in 2000, the mobile revolution is over. Everybody has a phone, but Apple knows how to charge you for growth. Facebook knows how to charge you for a customer. Twitter knows how to charge you for a customer. So all those years when we were doing Web 2, you go on Twitter and market all day and get users. Forget that. So those days are over of getting customer acquisition. So we have this problem where there's no new way to get customers. And because those companies price their users, their ads well, and then the token economics thing that was kind of a scam always has blown up. So that was the fake lie of this last part of the bubble is, oh, we'll launch a token and that'll be our way to get new users. We'll airdrop some person their token and they'll use our product. Guess what? Are they using your product? So there was a lot of that going on. So we had, I feel the biggest problem is that you got good founders coming out, you have technologies coming no matter what, valuations are coming down, so that's good. But the problem is, how are you going to grow? We're in a no growth economy because of deglobalization, higher interest rates, and the fact that the centralized overlords that we have charge a lot of money for a customer.
The Apples, the Googles.
They know how to price what a customer costs.
Interesting.
Yeah. So that is our biggest problem.
Now, even in this environment, is there anything right now that kind of in the private markets that you're excited about, any new shiny objects?
Yeah, I'm super excited of it. Yeah, I'm super excited. We like backing, if you've ever played, you're too young, but there's a board game called Risk, and it's a flat board game. It's world domination, right? Seinfeld episode about it, whatever. It was a game that we all played. You'd put it on a table like this, and the idea was to take over the world. And it was just a map with armies, and you picked where you wanted to start your battles. And I always started in, if you learn, Web 2 is about Facebook and being in your, just expanding from the center of the world, raise millions, hundreds of millions of dollars, and we'll take over the world. We'll hire 1,000 engineers. And blah, 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 blah. Well, guess what? Now the board game's changed, which is the way it should be. And really,
we're not trying to take over the world anymore?
Well, starting in Europe is impossible to win the game. So you start the game in the corner of the world, like in Eastern Australia or in Chile, and you build up your armies and you slowly move out into the world. And I love that aspect of startups where it's I don't need your $1 billion idea up front. It's what's your go-to-market? Who's the team? How much domain experience do you have? So I feel there's lots of that going on. What we need is realistic expectations about how you can grow your audience because it's very expensive. But NFTs are a super interesting byproduct of the blockchains. And although we're very early in what non-fungible tokens are, they really are this gateway to digital scarcity. Scarcity and utility are beautiful things in a digital world. Completely different use cases. Scarcity is about art and about I own this and there's only one of them. And utility is more oh, I'm a member and membership has its benefits. So I think there's going to be 1,000 Amex platinum cards in the digital world, and those who can build communities and profitable businesses around that. It's going to be cool. And then, of course, art and projects, but that doesn't interest me.
Yeah.
As a venture.
So last question, nobody knows more about Twitter than you, in my opinion.
Sadly.
You were an early user, and you've been one of the loudest critics out there of their mismanagement over the years, and you made some really valid points. I mean, here's a company that's built this invaluable product that the entire world relies on for information. I mean, the chart report that's come out of, curating it all and all that. And it truly has become the public square. I mean, even the Pope tweets,
So can't miss the Pope. The Pope tweets are killer.
I'm sure you got him on notifications.
I blocked him.
But if it was up to me, I would put you in charge of. I would have Howard Lindzon, CEO of Twitter. So let's just say
it's an easy job because you don't have to show up.
Let's just have some fun. Let's pretend for a sec you're the CEO of Twitter. Howard Lindzon's the new CEO of Twitter. What are some of the changes you're making right off the bat to make Twitter profitable?
Well, thank you. The question really is, the company didn't. Twitter was great from the minute it was coded. Like Jack, just like Square, he coded something, or Ev, or they built something that was indestructible. Like this way to communicate in short bursts, 140 characters, and it was before the iPhone, right? So it was a BlackBerry-based, web-based product. Like that's unbelievable. Like so, it survived. iPhone made it it was great on the BlackBerry and it was great on the desktop. I still mostly use it on the desktop.
It used to be you'd text in the tweets, right?
No, you could only read it on a BlackBerry. There was no smartphone.
Oh, okay.
Meaning BlackBerry had a pin. Okay, this is a history lesson for you young-haired. BlackBerry had what made it cool was BlackBerry said bankers would pin each other because it was a way around email. It was a way to not be detected by, you could talk about stocks.
You wouldn't have your
each BlackBerry to BlackBerry. That's why BlackBerry took off amongst bankers. I'm not a banker, so when I saw Twitter, I'm like, oh my God, we can get to talk like bankers do, but publicly. So I saw it as just BlackBerry 2.0. This is before the iPhone. But anyways, I don't want to run Twitter because running Twitter means you're going to get death threats because there's that many people. Like I have StockTwits and people want to kill me. Yeah. That's just 1 million people. Imagine having hundreds of millions of people. So I think part of the problem is it's a shitty job because you're dealing with the public square and people take shits on the king. Yeah. So like if you go to you come here and any big city has like problems if you're living in the city. So it's a tough one. I think the problem is quite simply it doesn't have the right business model. They aren't Facebook, and ad-based businesses, Web2 is a terrible business model. So the reason I loved Twitter at the beginning is I thought they could be Bloomberg. I only saw Twitter as something that was utility towards sharing information. So I think Twitter's the best product ever created for people that are curious. Because you get to tap into the minds of other curious people.
What do you think the problem is with adoption then? Why aren't
Who
more
cares?
people using it?
Why is the problem with Facebook is adoption. Everybody's on it. I don't want to talk to my family. I don't want to talk to my ex-girlfriend. Not that I have one, but I'm saying I don't want to talk to people.
The problem is adoption, yeah.
The problem is adoption. Twitter's genius was that it wasn't for everybody. Okay, but they raised so much money they had to make it for everybody.
I hear that all the time. I'm sure
everybody.
you do too. Like, I don't know how to tweet. I don't
Thank
use
God
Twitter
you don't.
because
You shouldn't be on Twitter.
Yeah.
Most people shouldn't be on Twitter, and so the real model is the people that do contribute reward them, and the people that contribute well reward them more, not by so how do you do that? And Web 2 didn't give you that model. Web 3, where you can have digital rewards and digital things matters, and digital power and like gaming matter. So I think Twitter, if I was to run Twitter.
Give me 3 things.
The first thing I would do is fire everybody, or fire enough people that you get a fail whale.
New blood.
No, and so there'd be 3 things that happen at once. You're fired, except for the engineers. Okay. The second thing is no ads. So we're going to take revenue to 0. Okay. I
asked you how to make it profitable.
No, because if you cut out their revenue and took revenue to 0, Okay, they could fire 75% of their people. Okay, so you're only taking revenue to zero, but you're also getting rid of 75% of your heads. The stock would go up, meaning the network value of Twitter with no revenue is probably 20 to 50 billion. Yes, that's the experiment no one's willing to run, because Solana, which has no revenue, is worth 10 to 15 billion, and no one uses it. So the network effect of a centralized thing like Twitter, even with no revenue, is worth 20 billion, is what I speculate. Okay? Therefore, get rid of the revenue and reprogram it with less people, and then go sell the product. The people that should pay the most for it, Goldman, JP Morgan, Bloomberg, Reuters, public companies, they'll pay. So charge the people that are willing to pay, and everybody else, it's a utility. And then charge access to the utility based on usage. And you could probably run that with 1,000 people, and the revenue would be a cash king. And then the true management of that company could say, listen, we're not political, we're not trying to be a free speech thing, we're just a utility. And that's really what it is, a utility. So I mean, it's not going to happen. And I would
like to dream.
Yeah, but that's really what needs to happen. You need to experiment like Kerplunk. You need to pull out all the plugs, because the product's the best product in the world. And as I said before, the problem isn't users. The problem is too many people are using it that really don't need to use it. It's, you know.
Yeah, I mean, right now the reward for putting out good content is you get bots. You get imposter accounts.
I hear that. I totally hear that. Somehow it doesn't happen to me. I feel like, and I say this with all the experience at StockTwits, I feel like Elon, like, that's his shtick.
Oh man, we're going
He
there.
wants to get trolled. No, I mean, that's traffic. If you want to be mainstream, you're going to get haters. Yeah. I don't want to be mainstream. I don't like what comes with that. I'd like to dip in and out of celebrity, meaning I don't mind being famous on Twitter, but I don't want to be accosted in the street. Elon is not scared of whatever, he may be insane, but he's not scared of being accosted in the street. So he gets love and hate.
How do you think that's going to happen, by the way? Do you think they're going to force him to buy it? I don't know.
The Delaware judge, it seems like it's hard to force someone to pay $50 billion, right? Even though he's in the wrong. You can't just. So I think there will be some form of settlement. I think I was okay with him buying it. I'm not okay with him believing he's above the law and change. I hate this whole thing where everybody's pulling the strings and I'm acting like they're above the law. That's what bothers me. Yeah, it feels like they're cheapening what is one of the benefits of America, which is this privilege to invest and communicate.
You made a meme out of the company, basically.
No, but Twitter allowed this to happen to themselves. Twitter doesn't need a board of people that are worried about revenue when their real problem is that it's a utility company. And so it's doomed. But it's not doomed to disappear. It's just doomed to be this soap opera and an underperforming, it's not a good stock, it's a great product.
Yeah.
It's my favorite product, I think.
Well, one theme throughout all your ventures has always been connecting people and leveraging social media to make better investment decisions. And I'm a product of that. You gave me my start on StockTwits almost 10 years ago. And before that, I really didn't have any way of...
10 years?
Yeah. Before that, though, I didn't have any way of sharing ideas or connecting with anyone. I didn't have friends that I could talk about the markets with. So it's an extremely valuable thing that you've done and just your whole mission. Really appreciate it and everything you've done, and thank you for coming by.
All right, thanks.
Take care. We'll have to do it again sometime.
Go chart report.
So thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.